Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate.
Hello there.
Welcome to Black Boulder, the channel solely dedicated to trading and investing. We'll be looking at market news, chart analysis, and strategizing. In this very first episode, we'll be discussing some upcoming calendar data and what to expect from it. We'll take a look at the layoffs, especially in the last week. We saw that Amazon is cutting personnel, as well as Goldman Sachs. They're sacking 3,200 people, and it's not a laughing matter at all. Also, I admit, I don't really have a good mic, and it sounds like it's crackling a lot. I will be replacing this thing, but shitty ear, shitty mic. Let's get on with this. Let's take a look at the market news, people. There we go. And what a year. 2022. We'll start off this market segment with most important data, the CPI for Thursday, January 12th. In this case, if we see a decrease in inflation, it will probably give a tailwind to most of the markets. And this might be a great trading opportunity, not really a great investment opportunity. Let's take a glance at inflation data versus US interest rates. The inflation data is overshadowing the interest rates. And we know from historical data that interest rates should surpass the CPI only to tame inflation. And while that still hasn't happened, it's a very uncertain market and literally could take all your shit away. Give your money to me, bruh. Looking at market volume, what's going on? This is the end of the year, and the most bruised and battered stocks, technology, has been filling up with volume. As we look at the top 5, we got Tesla, Apple, Microsoft, Amazon, and Nvidia, all badly bruised. Well, not all of them. I mean, Apple was still surviving, although they had the headwinds, especially coming from China and relocating their chips factories. However, the volume in Tesla has been increasing, while the stock itself has been pushed down over 65% year to date. This could be a massive trade. I mean, if a stock is battered and bruised like that, has a discount which is high, well, that will attract some buyers, definitely. And we might see that playing out in the next couple of weeks. Then again, if you look at the tech layoffs all the way from 2022, they're absorbently high. And that's also reflected in the chart, as NASDAQ has plunged the most against the other indices like the S&P and the Dow Jones. So while that's been the sentiment in 2022, sell-off technology, it seems that 2023 has started with a reverse. People are buying up technology stocks, the NASDAQ, and selling off energy, despite of more companies coming out and slashing more jobs. This by no means is restricted to technology, and it's been going on in the finance sector as well. Without a further hold up, let's go to the charts. Let's take a look at the US dollar monthly chart. What do we see? I got a couple of lines drawn, like the white sloping line. That's my trend line. It's been holding there for multiple years, a decade. We got the green line with a double bottom, which was placed in 2017 and 2021. And if we zoom in further, On the weekly chart, you'll see it a little bit better, but the green line is the multi-year support, the red line is the multi-year resistance, and the dotted yellow line is a soft resistance because it only has been tested twice on the monthly, and that's not enough for me to actually place a hard level. If we take a further look and we zoom in towards the daily, we can see that the dollar broke out of his expanding channel like a trumpet and fell down below the 200 SMA. I think you saw the 200 SMA on the monthly and the weekly chart as well. That's one of the indicators I tend to use a lot, purely to see what institutional traders are doing around those levels and algos. A quick peek on the 4-hour chart reveals that the dollar not only fallen below the 200 SMA on the daily, it also started to consolidate in the channel, which I marked with the yellow lines. I'll be looking for the dollar to break out the channel either to the upside or the downside and successfully come back and retest it. But the way it's been looking today, it seems the dollar broke out to the downside, and at the moment of making this video, it's retesting the channel. Mind you, that a successful retest will continue the downside for the dollar. So if the dollar is the car, the 10-year yields will be its engine. So let us gaze upon this monster. Look at this rally, stemming all the way from 2020 and only been given a tailwind in 2021 and going absolutely berserk in 2022. This is one of the highest jumps in over 4 decades. So for now, what the indices bulls want to see is that the 10-year yield will pull back to the upper band of the consolidation channel. This has to be apparent on the monthly chart. And for the moment now, the weekly chart is telling us that it's keeping above the yellow dotted trend line, but once it breaks that line, it absolutely has a chance to pull back to the broken resistance. There might be some good room for it either. As you see, the 10-year yield topped out and are heading to the downside. And it kind of looks somewhere similar to a normal ABC pattern. A break of the trend line will actually confirm this for us. So what is it what we have to look out for, folks? Well, for starters, we'll take the trend line, the yellow dotted one. If that keeps intact and keeps the market above the line, there's most likely a good bullish case for the 10-year yields to go back to the previous top. If this trend line gets broken, there is a high chance that the yields will retreat back to the broken channel to retest it and wait for the yield bulls to come back into the market. And that will probably only happen after CPI spikes and the Fed decides to raise the interest rates with the highest raise we had seen so far. Oh boy, going to the most exciting part of the charts, and we get to the first indice, and this is the SPX. The monthly chart. Nothing super complicated over here. The white trending line is keeping up the market for over a decade, and it's been bouncing off that trend line over and over and over again. The second thing we might look at are the green lines. The first, starting from the bottom, the resistance and support of 2000 and 2008. And those are two tops of two crashes, which have held a formidable resistance and now turned into a support. It's a highly important level to look at, but somewhat unreachable in my opinion, unless things really go sideways. And if we look a little bit higher, we can see the support of 2018 and 2020. If the market actually reaches that level, we might find some buyers there, but for now, it's quite a ways to go. And before we see what will have to happen to actually reach that point, we switch over to the weekly. And the first thing that catches my eye is that the market has been bouncing off the 200 SMA subsequently all the way back from September. So that tells me that even though the interest rates have been increasing and inflation actually peaked, it didn't peak enough to break that level. And before that happens, we would have to see a higher increase on the CPI, as well as Fed reacting to those CPI levels by increasing the interest rates. It's as simple as that. And before that happens, we still have a month or two to go. And if there is a viable bullish case for this chart, the first thing we would have to see is the SPX breaking the 4,000 level and bouncing off from that. If by any chance the SPX can break through that level, there is a good chance to short the index and wait till it reaches the 200 SMA. If we pull back the charts that we just discussed, the dollar and the 10-year yield, that is highly unlikely. I think in a short period of time, the indices will rally to a certain level that is noticeably a B-lag on a monthly chart. That thesis might coincide with the dollar going back to its broken channel as well as the 10-year yield. Well, that's it, folks. We're at the conclusion of this video. If you gain some knowledgeable information from this, make sure you put some call options on the like and subscribe button. I will be posting videos every Tuesday, Thursday, and Saturday. Until next time.
I don't get it, kid. You borrow money to go to NYU. The first year out, you make 35 grand. You made 50 grand last year, and you still can't pay off your loans. Where the hell does it all go?
Dad, 50K does not get you to first base in the Big Apple, not anymore. Look, I got 40% in taxes, 15 grand for rent. I got school loans, car loans, food, parked my car. That's $3 a month. I need good suits, $400 a pop.
So
shoes.
come back home and live rent-free instead of that roach-infected place you're living in. $50,000. Jesus Christ, the whole world's on it.